what's the single largest expense that a business owner has while they're operating the business?
Right.
Taxes.
Tax.
What's the single largest expense that a business owner has when they sell the business?
Yeah. They
Tax.
get you at both ends. They get you every direction.
Right. So at the end of the day, all roads lead back to tax planning. And, oftentimes by the time they come to us, they got that LOI out, they got the term sheet, and they're like, oh, what's going to happen to my taxes? Or the CPA will figure out the taxes.
Yeah.
Too late. That's not tax planning at that point. That's tax preparation.
Right.
So, in your experience, what is the best time somebody who is contemplating an exit, when is the first time they need to reach out to an attorney?
Yeah, I mean, as soon as possible, because you really want to have, a structure in place as early as possible before a transaction. The more time you have, the better, as far as when we're trying to plan things, because there's lots of things that you can do if you need to restructure a company, which when I say restructure, it's just basically, hey, you get a tax attorney, somebody to come in and look at it. And we go, man, if you sell this company or if this happens, it's going to have you're going to take a bad tax hit on this. And we can do this a lot more, what we'll call like tax efficient. And a lot of that, comes with, you need to have time to be able to complete the restructuring. And maybe, if I have a couple of years that pass between the time you did that and the time you complete the sell, if anything ever gets challenged or there's any issues with the IRS, I've got much more of a basis to claim, hey, this was done for this reason and it wasn't done. We're not going to try to, put this together with the sell and try to, take back more taxes, basically. That's as early on as possible, not just for the taxes, but even as you were mentioning about the LOI being signed. I mean, if you can get that LOI, get the attorney involved before the LOI is signed, that's going to be advantageous. But really, even before that, I mean, if you think you might want to sell, or maybe you want to transition to your family, or maybe you got a key employee you want to transition the business to, all that is, get an attorney involved early on in the process and just kind of have them there, as you need them to give you advice.
Yeah. So one of the conflicts that always seems to arise is business owner, while they're operating, they always want to pay as little tax as possible. So they're going to the CPA and they're saying, hey, find me all the deductions. Mm-hmm. But oftentimes, as we know, that doesn't really bode well when it comes time to sell the company.
Right.
And so how do you resolve that conflict where, you got a business owner who's relying on their CPA to take deductions, and, God bless the CPAs, but the vast majority may be doing compliance only. They're not really doing advisory work. And so what should the business owner be asking the CPA as they're going to them and saying, hey, what are the deductions I could take here? Thinking about, hey, one day I'm going to exit this business.
Right.
Right.
Right. I mean, that really, you want as a business owner to kind of have a team of advisors. It's kind of like if all you have, what's the saying? If you have a hammer, everything looks like a nail. It's like when people are specialized in one area, they tend to just focus on that. And they think, so in this case, the CPA, if they're just doing your tax return and they say, well, I can get you this deduction or this deduction on this return because, we're reporting this now. We're talking about things that have already happened. That's great. But you want to have a team of advisors, a financial planner, you're an attorney working with your CPA and your financial planner, and all that team kind of working together to make sure you're covered from all angles. And then obviously the estate, like you said, with your friend, estate planning. I mean, all of it goes together if you have a closely held business. So I would say, really just looking to see if your CPA can introduce you to those people. And, like I said, meet a few people so you're comfortable with, make sure they're competent, hopefully they're not sending you somebody that isn't. I really think you need that because, like you were talking about, Avo, with taxes, I mean, it is a huge part of owning a business. So it definitely cannot be an afterthought. But, like in my practice, I'm kind of a hybrid of tax and corporate. So I at least cannot I do in the deals look at tax as another aspect of the deal. So if we're trying to negotiate an LOI and maybe a buyer has a really good reason they want to structure this as an asset sale for tax purposes, Well, that's fine, we can at least know going into it. We're not going to have the wool pulled over our eyes, right? We're going to know. Okay, we know what they're doing. They're actually getting a win in the deal off of us giving this to them. So maybe they're going to have to up the purchase price, or maybe they're going to have to get us better terms on the note, or just something more favorable in the deal. It's just another deal point to trade off. So,
yeah. Speaking of conflict, I want to talk about when a business owner has a partner, right? A lot of businesses have partnerships, or partners rather. And at some point, voluntarily or involuntarily, that business is going to come to an end. And we're talking about how to structure the sale from a tax efficient manner. But when we're talking about tax efficiency in that case, we're talking about the individual owner's tax efficiency, not necessarily the business's.
Right.
How do you go about that conflict where you have one owner that's ready to exit, but their tax needs diverge from the needs of their partners, and all of a sudden this really good relationship that they've had where they've made money all these years, all of a sudden now, I don't want to say it becomes hostile, but there's competing interests now, right?
Right.
So how do you handle that? And I'm assuming, obviously, there's the attorney that's going to represent the corporation, but then everybody starts lawyering up. How do you start getting your attorneys involved without getting your partner to start lawyering up and turning this into a hostile situation?
Right. I mean, typically you would have an attorney that represents the company. That's a common situation for us. But what you're talking about is maybe we've got a client that, we represent the company, but it turns out the company is owned like 85% by this one person. And now, that person has their own interest and they're trying to transition the business. And so, we as attorneys have to really be on the lookout to see, well, is there a conflict here? Because we have to say to everyone, hey, we only represent the company, and we can tell you what the tax consequences are going to be. We can tell you kind of what the results, we can analyze it and say, here's what's going to happen if you do this. But in that situation, if I represent the company, I can't advocate and negotiate on behalf of that one owner or on behalf of the minority owner. I mean, it really, so yeah, you want to, as far as kind of the practical way to work through that. I mean, I hate to say this as an attorney, but most of the time the business people getting together themselves and working things out informally, they have a relationship with one another. You really want to rely on that as much as possible. I mean, that can be, like I said, I'm cutting it in my own work here, but that can be way more efficient, when you're trying to, negotiate and figure out, okay, how are we going to wind down this business, or how are we going to transition it? And just kind of one quick comment on that, kind of related to that, is the more you have in place before you get to that situation. So you have, what we call like a buy-sell agreement or a shareholders agreement, or maybe you got a partnership agreement. He has this stuff in place. This is all non-tax, but it's extremely important. It's what we call, I may have a Rick Perry moment here, but I think it's the 5 Ds. It's death, disability, divorce, debt, which is basically like bankruptcy, or default, like someone's just in default of whatever they're supposed to be doing. Like you want to have something that says, okay, what happens if that situation occurs? I really wanted to go into business with you, but something happens to you, you get hit in the head, or I get hit in the head. I don't necessarily want to be in business with your spouse. They're nice, but they're not the person I signed up to be in business with. And on the same end, I got to know, well, if I get hit in the head, is my spouse going to be protected? And how's that all going to work out? If you can work that out ahead of time, you're in a much better situation. And this what you're talking about is maybe a founder's exiting a company. And so you've got kind of a retirement. If you even have that worked out ahead of time, it at least sets a floor. Basically, we look at kind of the buy sell as like, people can always work out terms on their own. So maybe they say, whatever that buy, we don't want to do that. We want to do something else. If everybody agrees, people can do what they want. We just have to agree with one another. But this is kind of here as like insurance in case sometimes people don't always agree, or sometimes memories can be, we can have memories that maybe are more favorable to us than what actually happened.
Information contained in this podcast and accompanying video have been derived from sources believed to be reliable. This content is not guaranteed as to its accuracy, and does not purport to be a complete analysis of the topics discussed. Analysis is based on assumptions that may not come to pass. None of the content should be construed as legal or investment advice. You should consult with a qualified professional before implementing any strategies discussed. All expressions of opinion reflect the judgment of the speakers on the date the video was recorded and are subject to change.